So my client was able to buy this $350,000 house, only coming out of pocket $2,100 for his down payment and closing cost. While that's not typical, it is possible, and what I've found is many first-time homebuyers often greatly overestimate just how much money they need down in order to get into their first house. So in today's video, I'm gonna cover the number you should start budgeting in your mind for the least amount down possible when you're factoring in down payment and closing costs, and share with you the real-life example of my client, again, this house right here, and how we were able to shrink his down payment to, again, only $2,100. And I'll wrap it up with some of the pros and cons, because if anything sounds too good to be true, it usually is. And of course, there is a downside to going the lowest down payment possible. However, spoiler alert, in my humble opinion, for most people, the pros of going the lowest down payment possible rather than waiting for a larger down payment heavily outweigh all of the cons that do come with it. So if you find this video interesting, useful, relevant, please like, subscribe, leave a comment. Anything to help with the algorithm is super helpful. Now, let's dive into the numbers. So the first thing when it comes to budgeting, how much you need to start saving for and looking at homes, is understanding it's your down payment and your closing costs. A lot of people forget about the closing costs, so we'll go into that. But let's start with the down payment. So the down payment is the amount that goes towards your principal. The lowest amount of any standard program available is typically 3.5% with an FHA loan, Federal Housing Authority loan. So that covers the down payment side for the mortgage. Now there's the other side, which is the closing cost. It could vary based on all kinds of things, like the time of year, how much property taxes you're gonna have to owe based on what time of year you made the purchase, how many months of your homeowner's insurance are you going to put in escrow immediately. Could be 6, could be 12, people have different approaches, all kinds of variables, but a safe number to go with is 3 to 3.5%. So for this example, we'll use 3.5%. So our down payment and our closing costs combined puts us at 7%. So keep in mind, when you're looking on consumer-facing real estate conglomeration sites like Zillow, Realtor.com, look at that sales price and then think in your head, okay, 7%. If I can come up with that, great. Let's go check the house out, set up an appointment. We can do this thing. Let's own a home. But if you can't come up with the 7%, let's do some exploring. Doesn't mean you can't buy the house, just means we have to look at some different options for the down payment. Because what I found for most first-time home buyers can afford the monthly payment on a mortgage for a house that they'd like to own. Their biggest hurdle is that down payment. So just because we can't come up with a full 7% right now, doesn't mean we can't still get in the house. So now, knowing that, let's take a look at our real life example of our client who, again, purchased this house for $2,100 total at closing. So in order to do that, we took advantage of 2 programs. First and foremost, because he was a combat veteran, he was eligible for a VA loan. Now, VA loans are awesome, and anyone who qualifies for a VA loan, I highly encourage you to go explore that option with your professional lender, realtor, if it's me, we'll talk about it, or whoever you're relying on for professional opinions, because they are 100% financeable. Meaning that 3.5% we needed for a down payment, gone. We don't need that. We just need to focus on our closing costs, that other 3.5%. So in our example here, at $350,000 for the sales price, at 7%, that means my client would have to come up with $24,500 to get in the house. But by removing that 3.5% down, by taking the VA loan, he only has to come up with $12,250. Yeah, that's half. Yes. So now let's talk about the second program that we used for him. So because this was his first time home purchase, he was eligible for Florida's first time homebuyer assistance program, where Florida will give you $10,000. Let me rephrase that, where Florida will provide $10,000 in down payment assistance to help lower the cost of entry to get in the house and tack that on in the form of a second mortgage. So you're still paying that $10,000 they're providing you. It's just stretched out over the course of the mortgage, as opposed to all up front. So now once you apply that $10,000, that gets us to $2,500 in theory, what we need to come up with to get into the house. That actually ended up being $2,100, and Funny story, because he put $2,500 down for his earnest money, that was applied to the $2,100. So at closing, he didn't even have to wire anything, and they applied $400 of that to his principal. Pretty cool. Now let's say you don't qualify for those particular programs. There's still other options out there to help you shrink that down payment if that is the biggest hurdle between you and your next or first home purchase. That being said, there are dozens of programs at the federal, state, and local level, and even your lenders will often have unique programs for different buyer profiles based on their credit, down payment, work history, bank statements, where they can compile different components of your financial picture and put you in a specific program where they've categorized you as a relatively low risk, and they'll help you get into the house with things like a lower down payment or a lower interest rate. So when you're looking at making a home purchase, don't be dissuaded by just how much you need to come out down. Talk to your professionals, talk to people you know in the business and the industry. Start exploring some options. Now let's talk about the downside, because anything that sounds too good to be true probably is. And in this case, there is a downside. It's not perfect, and obviously so. That would make sense, because we can't get the same benefits of someone who is a lower credit risk because they're able to come out a larger amount as someone who is coming out zero or a much lower amount for the down payment. So what is that trade-off? Well, the trade-off typically comes in the form of a higher interest rate, not just because the principal amount owed on the mortgage is larger by nature of not putting more money down, but also in the forms of things like property mortgage insurance and potentially a higher interest rate than someone who was able to put substantially more down on their initial down payment. So for whom would it make sense to utilize a down payment assistance program versus waiting to save up some money and having a larger down payment and lowering your monthly mortgage rate, whatever, by eliminating things like PMI or having a reduced interest rate? Well, if you have a great living arrangement where you're paying little or nothing for housing, everyone involved is happy with it, it's stable, you like where you are, there's no issues, it might make sense to wait, 6 months, 12 months, maybe even 18 months before you pull the trigger to eliminate things like the PMI or have a lower interest rate. But for anyone else who is paying market rates for rent here in the Tampa Bay area, it is very difficult to make the case that paying rent for 1, 2, 3, 4 extra years to reduce your monthly mortgage payment in a cost-benefit analysis over the span of the next 30 to 35 years, that makes more sense than just going ahead, making the purchase. And if you want to refinance when rates come down later, it'll cost you some money, but you can still do that and bring down that payment. I'll go ahead and flash this chart right here. Pow! Maybe I'll do an effect on that. I'll go ahead and flash this chart right here. I think it's an interesting way to look at these kinds of questions because the rent versus homeownership debate is so hot. And since I'm a realtor, anything I say that encourages buying is going to be considered self-serving, so I understand that. But one thing you may want to consider is taking a longer-term view of something like a home purchase. What this chart does is it illustrates pretty clearly the cost of waiting to go ahead and just get in the house, because rent prices are still going to go up. But when you get a mortgage, you've locked in your mortgage payment. Your insurance will go up, your taxes will go up, but those are still gonna go up on whatever place you're renting at. Just because it's not a line item doesn't mean you're not paying it. So relatively speaking, you are locking in your cost of living while your cost of living for rent will continue to go up while you get zero equity. So again, I'm not gonna get too into the weeds, to each their own. I'm not anyone's financial advisor. The decision is yours, but I thought that'd be one helpful perspective to take into consideration. Now, if you're considering a move, I'd love the chance to be your real estate resource, whether that's in 2 months from now or 2 years from now. Reach out to me to the email in the description below, and let's have a conversation. Thanks for watching.